The following video where I'm going to present about the financials. Introduction. The majority of the people is interested in one or another way in financial for some resource, especially the money. The desire to climb socially, improve the quality of the life, and the give in better opportunity your firstborn. A theory of price from the supply and demand relationship consumer, the capital market, and the taking of decisions, which should be processed a number of economic variables. The financial is between the two relationship and economy and accountants. The relationship with the accountant is established because of the supplied facts about the financial health of the company through accountant reports. The financials and the nexus of economic and accountant because they connect the theory of economic with the features product in financial state. The financials has to offer an overview of financial and the objective of study what are the objective on administration finance and the principle that give its action. Objective of the finance. Finance represents the branch of economy that deals with the matters concerning the value. The objective of the finance is to maintain the wealth and shareholders. The concept of maximum value general and question of the measure is the company oral or destroy value. The profit involved two big reasons. First, the term gains mean that they can be short or long term. Second, earning ignore the value of money at the risk taken to obtain them. What are the costs and actions of those managers and shareholders have the same goal? Is it when the shareholders hear manager or administrator exercise the administration of the company? If the administration does not carry formal investment, then shareholders must spend on the net to monitor the action of the administration. If we talk about corporate finance and financial management refers to the investment decision, which very often and for various reasons will be analyzed so that the first asset must be purchased, that value must be greater that its cost to increase the value of the actionary. I continue. Are there three types of finance? Finance decisions determine how that first finance investment decision and the right side of the balance lies. Finance investment is the one where transactions are made by accountant and other of the third party which does not belong to the organization but the customer. Capital market. The scope where a series of financial instruments called title of values which can be bonds, stock, corporate bonds, and derivative products are traded. The vision of company. The visions of the investment mechanics. There is exchange of money and real assets to channel investment, provide the framework on the analysis to see how the firms interacting with the rest of the economy agents. The vision of the accounting model. This is a byproduct of the vision of the mechanism of investment and the concentrates of the structure of assets and liabilities. The overall contract. This is a set of explicit and implicit contracts among these are economic agents with which in the maintenance relation stakeholders. Continued for the functions and the objective of financial manager. Capital budget, capital structure, work capital. Capital budget finds those investment opportunities that generate value to the company. This takes of the decision requires refined calculus and measure of profitability. Capital structure. This is an optimal mix of the action and the maximum the value of the first minus the value of capital and the working capital. The efficient structure operative purely in the short term. Primary and secondary capital markets. Primary financial markets are those where the exchange asset the nuclear create. In secondary markets do not create new debt or new action, simply change to the owner of a financial asset. Credit market asset abstraction preferred by intermediaries that obtain much of the their resource through the collection of deposits. Markers or capital and monetary markers. Money markers are those in which the titles with the interior of the year matures are negotiated while capital markers are negotiated long-term titles, such as obligation and action. Finally, and the point were referred to the globalization usually used for the global effects or international trade and cash flow. We live in a world where financial transactions have become global. Today it is a much easier to move capital quickly to other places in the world and the transaction costs. Uh, Finally, managing accountants for focus on forecasting. They have gone exciting and forward-looking strategy role in many different types of organization. Many trained managed accountants and her or top businesses in which varieties or roles in them demanding financials analysis or financials director. The contribute to decision making across the organization. The analysis the probably is vital in taking business forward.
I talked all about finance and economic science, principle and life. In finance, we often use models to design a business plan, the valuation of a company, the optimal capital structure, and so on. Models are simplified representations of really and try to describe general situations. Many of the models used in finance are mathematics. There are several principles incorporate finance that constitutions an appropriate reference macro for understanding and solving problems. Which are the principles related to finance transactions? The principle of diversification, the principle of efficient capital market, the principle of zero sum game, the principal relation to evaluate and economic efficiency, the principle of activity and the life of conservation of value, the principle of opportunity cost, the principle of the value of good ideas, principle of comparative advantage, the principle of comparative advantage, and the principle of to the value of options. Finance represented that branch of economic science that deals with everything concerning value. The purpose of the bonds is to maximize shareholder wealth. In the way, investment decision and financing decision must add most wealth to the company as possible. The shareholder hire the administrator to exercise the management of the company. Conflict can generate to collect agencies costs. The most common agency costs are the indirect ones, although there might also be indirect costs. Principle of finance: an appropriate frame to reference of for understanding and solving problems. The situation in which the exchange between risk and return, if present, are many. In fact, they are always present investment decisions, begin very visible in fixed income securities that are listed to the capital market. All appear is the policy of working capital when we have to decide if we keep large inventories to meet demands or if, on the contrary, we try to minimize then to reduce maintenance costs. The latter increase the performance but also increase the risk of not being able to attend an order in time and finance decision. This relationship adds fair when measured to the combination between the general amplified to return of capital, but at the same time increases the financial risk before are possible insolvency. In finance, the set of assets held by an investor is called a portfolio or portfolio. To understand this concept is that you when closing a career related to finance or a diversified portfolio of subjects that completed your academic training. The head shoulder is the administration frame of reference to understanding and solving problems, increase to the risk of not being able to attend, though also a diversified case before a possible insolvency. The principle of comparison advances as the principle of the one option, which are the principles related to financial transactions, and describe general situations as much as the method used in finance and science. To reduce maintenance costs, the latter increase that be performed by also increase the risk of not being able to attend. An investor is calling this that you when closing career relate to performance. Many of the models used in finance when the opportunity cost the principle of the value and the idea more brand to economic time that deals with everything concerning value. The shoulder hire the administration to the management on the company overall. B. Interest cost principle of finance in appropriate frame to reference for understanding begin by visible in fixing economic security. I are the capital. On the contrary, we try to minimize to reduce maintenance costs.
From EBIT to net income. Immediately following the EBIT operating result, a series of items that represent the effect of financing, other income and expense, and sometimes extraordinary resources appear. We discuss them below. Financial result, normally divided into liabilities and generated by assets, but comprise mainly interest, exchange difference, price difference, holding results, and inflation adjustment. Other income and expense are those income or expense that do not have
a specific classification within which we have seen as administrative, commercial, or financial expense. Extraordinary income refers to extraordinary income or expense such as the sale of fixed assets, indemnities to employees, claims. Corporate income tax. Finally, if the firm shows profit after having subtracted all these concepts, it must pay corporate tax. The note to the income statement and the annex. The note and the annex to the financial statement clarify the composition of the items from a more detailed opening. If it is not distributed as cash dividend, it could be capitalized by distributing a dividend in share, constituting a reserve, or simply keeping it within a retained earnings account. In any case, it is always retained earnings that are reinvested within the company. The balance sheet reports the equity position of a firm at any given time. Normally, the balance sheets are presented on an annual basis, and the case of listed companies on a quarterly basis. The active assets are listed by decreasing degree of liquidity. First, short-term assets called current or current, depending on the country, consisting of cash and bank balance transaction investment, such as term deposits and bonds, after sales, and inventories. The liability. The liability shows just how the company finances its investment and represents two types of rights over the assets: liabilities and equity. A grouping under the accounting figure of equity. Equity or equity. Equity is equal to the asset less the liability. Is the shareholders will receive if all the assets are sold. Common shares and subscribed capital. Common or ordinary shares represent the true ownership of the company, as it is the common shareholder who make the capital contribution, assuming the risk of the business. Favorite action. Preferred share represent an intermediate point between common share and debit, since payments to the preferred shareholder consist of a fixed dividend. Retained earnings. The balance of retained earnings reflects a kind of current account of the company over time grows if the company saves reinvested in itself and decreases if it pays cash dividends.
Working capital. From the accounting point of view, working capital or working capital defined as the difference between current assets and short-term liabilities. However, working capital is far from static. On the contrary, it's constantly changed, and sales are generated on a permanent basis, and with them the accounts receivable and the purchase of inventory with the following account payable. We could say that this movement begins when products are invented and then transformed into products in process until the final products are obtained, and then the company sells to its customer with a profit margin. The financial statement or the report of the financial statement of the firm remains today the document that best summarizes the financial activities of the firm, and the firm requests the banking analysts, consultants, and research when looking to analyze the economic financial situation of the company. However, this information is only a starting point, and for good reason. They often do not provide critical information for decision making, and as we will see, financial statements may have major limitations in communicating the situation. Depreciation methods use fixed assets such as a plant or machinery to produce goods. These assets lose value with the use and the passage of time, or by technological obsolescence. This decline in value is a cost of production and therefore must be reflected in the income statement. As we have said before, public accounting use several methods to reflect this depreciation in order to spread the cost of the goods over what is considered its useful life. Research and development expenses and advertising expenses as an expense within the period in which they were incurred. However, often these expenses are more like investment than real expenses. An advertising expense is made in order to generate future sales. The research is carried out with the aim of developing a new product. In both cases, there is an association return. It is spent today in order to collect more money tomorrow. Every time there is inflation, begin the complication to show the actual result and financial position of the company. While these distortions have been mitigated by adjustment for inflation, they do not reflect the true impact on the company, because the financial statements are recorded in monetary units on the dates they are made. They add currencies with different purchase power. Inflation distorts by the balance sheet items and the income statement. The evaluation of the currency distortion factor is found in those countries that have devalued their currency. Such measures often break on balance sheet because strong devaluation takes place over short periods. Income transfers are often varied. For example, a company that exports most of its production and also has all its debt in national currency would, in principle, be greatly benefited by a devaluation. But The opposite will happen with an importer or with a company that has a debt in foreign currency. In fact, there will be a result of exposure to devaluation that will affect both assets, receivable, inventories, and liabilities, accounts payable, financial debt, and of course their result. Taxes are involved in almost every decision. The state is like a dinner rather than taking a portion of the pie representing the company's profit. There are numerous situations in which the tax effect of financial decisions can create value. One of the most important refers to decision of the capital structure, where debt offers clear tax advantage since the legislation allows the deduction of interest as an expense of the period.